Look at the modern business landscape, and you'll find a recurring anomaly. Massive, highly resourced corporations with top-tier management will suddenly and spectacularly collapse. Consider the video rental industry. At its peak, the leading firm controlled thousands of physical locations and dominated market share. Or look at the original architect of mass retail. They possessed an unmatched logistical scale and defined consumer purchasing for generations. Then there are the hardware manufacturers, who practically invented the mobile phone category, only to be wiped out in less than a decade. Under traditional strategic models, these firms did nothing wrong. They had highly differentiated products, defensible profit margins, and highly efficient daily operations. The flaw was not in their positioning. None of these giants failed because they lost their grip on the market. They failed because the market itself changed completely beneath their feet. To understand these fatalities, we have to turn to the economist who diagnosed this specific vulnerability nearly a century ago, Joseph Schumpeter. Schumpeter observed that capitalism is an evolutionary process. He called its central mechanism creative destruction, a relentless cycle where new waves of innovation dismantle old industries to build new ones. Traditional competition chips away at a rival's profit margins through marginal improvements. Schumpeterian competition targets the firm's very basis of existence, annihilating entire product categories. The horse-drawn carriage industry was not defeated by a company making slightly better carriages. It was obliterated by the automobile. Similarly, steam locomotives were not outcompeted by faster steam engines. They were replaced by entirely new sources of power. The fatal blow rarely comes from a direct rival. It comes from the periphery, introducing a new set of rules that the incumbent is completely unequipped to handle. This creates a severe mandate for the modern strategist. Asking how your firm is differentiated today is insufficient. You have to ask how prepared your firm is for the exact moment that differentiation becomes totally irrelevant. In the late 19th century, mainstream economics viewed the market as a Walrasian general equilibrium. This model treated the economy as a self-adjusting system. Any change was an external disturbance. The system would absorb the shock and quickly return to its peaceful equilibrium. Schumpeter rejected this entirely. He argued capitalism is not an equilibrium system at all. The constant disruption of that resting state defines the economy, and the agent responsible for shattering that equilibrium from the inside out is the entrepreneur. Schumpeter used a very strict definition here. Entrepreneurship is not about owning a business or being self-employed. It is the specific function of executing new combinations in the market. This creates a hard line between invention and innovation. Creating a novel idea in a lab is invention. Successfully commercializing that idea to disrupt the existing economic structure is innovation. But innovators rarely start with the necessary capital. They rely on the financial system, specifically credit, to redirect resources away from established uses to fund their unproven visions. Through this lens, capitalism is a continuous sequence of shattered loops and temporary restorations, driven by entrepreneurial credit. So why take the massive risk required to shatter an industry's equilibrium? The payoff is the temporary, dynamic monopoly that an innovator commands. We can see this in strategic rents. This chart plots profit over time. Traditional firms capture Ricardian or Chamberlainian rents for stable, modest returns. Disruptors target Schumpeterian rents, massive profits captured while novel, but as imitators flood in, that advantage decays rapidly. A company whose survival relies entirely on the fading profits of a single past innovation will not last. A successful firm converts those transient spikes into durable advantages, and then immediately starts hunting for the next disruption. Schumpeter published these ideas in 1942. Today, they form the hidden architecture behind almost every major framework in modern strategic management. Take David Teese's concept of dynamic capabilities. This theory instructs firms to abandon static hoarding. Instead, they must continuously sense changes, seize opportunities, and transform internal assets. Then there is Clayton Christensen's famous model of disruptive innovation. Christensen showed how incumbents fail precisely because they rationally listen to their best customers. This leaves them completely blind to Schumpeterian entrants. We also have Richard Devaney's framework of hypercompetition. This is simply Schumpeter's timeline compressed. Creative destruction now happens in a matter of months, demanding rapid, continuous disruption. Finally, modern platform ecosystems are the ultimate realization of a new industry organization. To study any of these modern theories without understanding Schumpeter is to study the symptoms without understanding the disease. They are all tactical toolkits designed for a world of continuous economic evolution. A master strategist cannot rely on just one of these frameworks. Analyzing a firm requires viewing it through three overlapping economic traditions simultaneously. First is the Bayesian tradition, which analyzes industry attractiveness and positioning. Second, the Chamberlainian tradition focuses on the firm's internal ability to defend unique resources against direct imitation. Third is the Schumpeterian tradition, which anticipates the total disruption of those competitive arrangements over time. Relying on only one of these creates a fatal blind spot. An attractive industry and strong internal defenses mean absolutely nothing if a new technology renders your entire product category obsolete. So the unified rule is this. Bain tells you if the industry is attractive today. Chamberlain tells you if you are positioned to win today. Schumpeterian tells you if your very existence will matter tomorrow. Translating this theory into immediate action starts with a strict rule. Your most dangerous competitor is rarely in your direct line of sight. You must continuously scan the periphery. Second, your firm's financial structure must be explicitly designed to fund unproven, long-horizon experiments. If every project requires an immediate return on investment, innovation becomes impossible. But the final and most difficult discipline of Schumpeterian strategy is psychological. You must be willing to actively cannibalize your own greatest successes. Look at Apple's ruthless transition from the iPod to the iPhone. They willingly undermined a dominant, profitable product to establish the next generation of computing. The investments, customer relationships, and daily routines that generate your current success are the exact obstacles that will blind you to tomorrow's shifts. In a market driven by creative destruction, if you refuse to aggressively destroy your own equilibrium, a competitor is already waiting to do it for you.